And joining me now to provide insight on the day's markets performance is Kyle Burgess from Nedbank Private Wealth. Kyle, thanks so much for your time this afternoon. So internationally, we're seeing some green screens coming through overnight. I think we also saw green screens from Wall Street, but trade still seems somewhat choppy. Are we seeing a mixed performance because traders, investors are waiting for more market-moving catalysts, this being, the US PCE print that's due on Friday, as well as those additional trade moves from Trump, which are set to come into effect or be announced next week?
Hello, Tarling. Yeah, thanks for having me on the show. Look, I would expect that we are seeing a small bounce in markets. I think that doesn't take away from all the risk that we've seen coming through markets during 2025, particularly on the geopolitical front, from all the tariffs that are being implemented pretty much across the globe. And the sell-off that we've seen in the S&P 500 and NASDAQ, we've seen some air coming out of the AI trade. And I think a lot of retail investors, particularly in the US, perhaps taking advantage of lower valuations, valuations which have pulled back over the last, call it 3 or 4 weeks. And interestingly, I think an interesting point that retail investors are getting in while institutional investors are perhaps a bit shy of this market at this point in time. So really just markets perhaps just gaining some steam on the back of that, but wouldn't lose sight of the long-term trend.
Now, before we get into some local company news, I want us to just speak about China for a bit. We've been seeing a lot of stimulus being pumped into China, targeting the economy as well as, the property sector. Some of the latest rounds of stimulus has been targeting consumption in particular. How have you been viewing that move and just your general sentiments around China, especially when it comes to consumption? Because we have been seeing sluggish consumption on that front, and that's quite important considering that they are trying to boost domestic consumption as those trade tariffs come into effect.
Yeah, certainly, Tarling. I think it's a very topical point in financial markets at this point in time. If you go back a couple of years, a lot of investors viewing China as potentially being uninvestable. I think you really need to pick through the risks there and try and understand the risk that you are taking, particularly with the Chinese Communist Party, what they're trying to achieve within China. And we did see a move from essentially growth at any cost in the late sort of 2000s, early 2010s, and towards a more equitable distribution of wealth. From about 2018 onwards, there was a lot of regulatory red tape that was slapped onto a lot of the tech counters. We saw those tech counters selling off significantly. And I suppose, there's certainly an argument to be made for saying that China is uninvestable. The view that we took, and we spoke at length about this within our investment team, was that China is a risk that we were willing to take. At that point in time, either through an index, or through NASPA's in process, and we were comfortable with that risk. But again, it is an economy that's growing at perhaps 4.5%, with the target to grow at 4.5%, which I think just in South Africa is a phenomenal growth rate to most other countries. But if you look at that in comparison to what China's done over the last 30 years, that certainly has pulled back significantly. The property sector, has certainly faced a lot of headwinds. We've seen a lot of overcapacity in that space, and a lot of Chinese nationals would hold their savings essentially in the property space, and that slump has really affected consumer sentiment. And we are seeing a move now towards more from this redistribution of wealth towards more of a market-friendly type approach from the Chinese Communist Party, which is nice to see. Certainly has buoyed markets and has come at a good time, with US markets looking particularly expensive and I'd say fairly vulnerable at this point in time.
I mean, even Jack Ma's out of hiding, which I found very funny when he met up with the president of China. Let's move over to some company news. Pepkor sealing a deal with Retailability. It's set to acquire major brands like Legit and Boardmans. What have you made of that move and just the timing of it, considering that discretionary spending is under pressure, consumers are under pressure?
Yeah, it's a good question, and I think if you look at both banks and retailers, you'd find that the businesses have done particularly well over several years in a very difficult environment. And I think Pepkor is no exception to that. They've got a dominant position in the sort of in the affordable type value space. I suppose over-indexed to kids and schoolwear, perhaps. So this acquisition, and I suppose put into context, it is fairly small. It makes up less than 2% of Pepkor. It will be settled in cash, but we're not sure what the acquisition price was, unless I may have missed that. But they didn't disclose what the acquisition price was. But certainly trying to get more exposure to adult wear, and then their specialty businesses through the likes of Boardman. So certainly positive, but not a massive deal, I don't think, in the life of Pepkor. And again, from their perspective, they have indicated to the market that they'd like to get to that 300 store rollout per annum, and that would be through acquisition and store rollout. So nice that they're getting those brands like Legit and Swagger under their belt, and certainly we'll be able to roll out additional stores on the back of that.
Before we get some stock picks analysis, just in earnings news, we saw Remgro out with results, delivering double-digit growth in earnings. That, of course, comes as most of its investee companies posted healthy growth. Markets seem to be upbeat about the numbers. The last time I checked, I think Remgro was up over 2%. Just your reading on that earnings report.
Yeah, so a pretty solid set of numbers. I mean, the share price was up at around 3% on the day, but your HEPS up 38% to 6.72 Rand, which is certainly positive, and quite nice to see from a company announcement perspective some positive things being said about the South African economy and the momentum that we saw in the second half of last year, which is essentially their reporting period. But again, this is a Remgro as a business, obviously an investment holding company that's still trading at quite a significant discount to its net asset value. So shares currently trading at about 158 Rand-ish, and the net asset value was up over the period 10% to 275 or 276. My apologies, 276. So a nice increase in that NAV over the period, but it is still trading at a discount, and I suppose not unsurprising, just given what we've seen in investment holding companies and the discounts that they typically trade at, and specifically with Remgro, where we've seen them move from holding significant positions in listed businesses towards more than 75%, I think, of their portfolio being unlisted businesses, which I think certainly doesn't make things easier from a valuation perspective. But again, this is all being underpinned by stronger performances in the likes of RCL Foods, Outsurance, which is, of course, a listed business. We've all seen how wonderfully that share price or that business has performed over the last couple of years, and then Mediclinic, which has turned around nicely over the last 6 months. So a nice positive set of results for Remgro.
All right, let's just hit pause on that conversation. Before we get to your stock pick, let's reflect on some counters that have found favor with your industry peers.
Yes, I think, Stadio for me is one of those, just put it in the bottom drawer and then let it run. So there is still huge optionality in the business. So if you look at the number of learners, they just breached the 50,000, and they're looking to reach 80,000 by 2030 and then 100,000 forward. And I think they will achieve that quite easily. So they're going to do a combination of obviously distance learning and contact learning. Yeah. Contact learning will be about 20% of the business. So that can necessarily try to compete with all the universities and so forth, but they will build a few. For example, they're busy with one in Durbanville. But really the distance learning that I like, I think there is immense opportunity, especially since you've got UNISA, which is, in disarray. So that makes it quite easy for them to steal market share there. And the things do change. For example, they get university status and perhaps they can get access to NSFAS funding and so forth. I think the growth will even go higher levels than it already is. And then lastly, they do generate a lot of cash in the business. Their cash conversion is very, very high. And so they've got a completely different J-curve to something like a Cura, for example. So I think Stadio can actually give you very good growth with good dividends as well. And I think that dividend underpin will probably come in really over the next 2-3 years. Already they're paying 50%, but I think they can even pay more, in the next few years. So I like it, buy it, hold it, and if there's any weakness, buy more.
This is kind of akin to that. ASML is the company that builds the big machines that produce the chips that is going to fuel the AI kind of revolution. They're already seeing very, very strong demand pick up from their biggest clients that include Taiwan Semiconductor and Samsung and Intel, that use those machines in order to produce the massive volumes of chips that are required to power almost every technological device, and also to power, to kind of process everything that needs to go into actually getting a workable AI model to a specific business or individual. So there's a lot of demand for what they are doing. The machines that they produce are low volume but high in value, and their order book visibility is extremely good. And it's not only the kind of high tech stuff that they're focused on; it's everything that they have exposure to. The monopoly that they have, though, is in the cutting edge chips that is used in these AI user applications. The stock isn't expensive; it's derated quite significantly, along with the rest of the semiconductor sector. So I think that now is an opportune time to get involved, and you can get exposure on the JSE. Yeah. It's one of the new F&B ETNs that listed today.
So Chantal picking ASML and Alex picking Stadio. Just your analysis on those counters, Kyle?
Yeah, Tali, let me perhaps start with ASML. I can't fault Chantal's thinking on this. You know, I think from just a tech viewpoint, it's a nice entry point into sort of the AI theme, and they certainly do make incredible machinery. And I mean, she mentioned there that it's a low volume business. I think in 2024 they sold something like 450 of these machines. These are incredibly sophisticated, and if I'm not mistaken, they currently have about 90% market share in the extreme ultraviolet lithography space. So certainly a dominant player, which is positive. Chantal may have mentioned that the stock is looking quite inexpensive. I don't know if 26 times earnings is that cheap, but certainly is looking a lot cheaper than it has in sort of historically for a business that will probably grow at about 20% over the next 2 or 3 years. I can certainly buy into that. And then from a Stadio perspective, look, I like the theme. It's not a business that we, in fact, cover, but we do like the tertiary education space and theme. And again, I can't fault the investment thinking on that.
All right. Before I let you go, then, what is your stock pick? What are you hanging your hat on today?
It's a very boring type of business, and I mean that in the best possible way. It's Netcare. So in the hospital space, they've got the majority of their hospitals in the big economic hubs of South Africa, Gauteng, the Western Cape, and KZN. So very defendable cash flows. They've gone through a period in COVID where we saw margins being reduced, or EBITDA margins being reduced significantly. There's been a nice uptick in those margins. And at the same time, they've gone through a significant spend getting essentially their tech up to date, or not up to date, but certainly putting them in a position to be market leaders from that perspective. So, you know, at 13 times earnings, I think Netcare looks pretty attractive. And again, very strong free cash flows and potentially room to increase dividends or perhaps special dividends. Not that they've said that they would do that, but certainly room for that with the strong cash flows that they are generating. So that's my stock pick for today. And yeah.
So Netcare, one to look out for. Kyle, thanks so much for joining us and just sharing analysis of trade at midday. That was Kyle Burgess from Nedbank Private Wealth.